Hi, my name is Chad Tyler. I'm president of Tyler-Donegan Real Estate. I'm here with my colleague Jeff Cahall and also Mario DeLuca of Aronson LLC, a professional accounting firm. We're here today to talk to you about corporate sale-leasebacks. As we're recording this presentation in July of 2012, the Great Recession that started late in 2008 has lingered on. And as a result, many companies today are finding it hard to raise capital and raise liquidity. And as a result, corporate sale-leasebacks is an option to help them raise capital. Before we get started in our roundtable discussion, I'd like to tell you a little bit about Tyler-Donegan. Tyler-Donegan is a full-service commercial real estate firm. We do sales, leasing, property management, and development. Geographically, our primary market is the Washington, D.C. metropolitan market, about a 60-mile radius around Washington, D.C. And over the years, we've been involved in a number of corporate sale-leasebacks. I'd like to ask my colleague Jeff Cahall on the right to tell a little bit about himself.
Thanks, Chad. I've been in the commercial real estate business for 30 years. I've practiced in 40 states and Puerto Rico. We've represented very large corporations and other institutional users, and we've represented small and mid-sized corporations. We've done several sale-leasebacks. They've been financially successful for our corporate clients, and we're excited about telling you more about the process today.
As I mentioned, Mario DeLuca is a partner with Aronson LLC. Mario, would you tell the group a little bit about yourself and about Aronson?
Thanks, Chad. My name is Mario DeLuca, tax partner at Aronson LLC and also the firm's tax practice leader. I specialize in real estate and spend approximately half my time in real estate for over the last 20 years or so, and work on a variety of real estate matters from compliance to consulting and structuring and beyond, quite frankly, across the spectrum of clients, developers, on up through real estate investment trusts. Aronson LLC is a top 50 national accounting firm that is currently celebrating its 50th anniversary and has as one of its core practices real estate and construction.
Aronson's a great firm. Tyler-Donegan and Tyler companies have used Aronson over a number of years, and we've enjoyed the relationship. Mario, we appreciate you being here.
Thanks, Chad.
Jeff, why don't we start off, and why don't you just give a very basic description or definition of what a corporate sale-leaseback is?
Sure, Chad, I'd be happy to. Simply put, a sale-leaseback is a financing mechanism that needs to be properly structured. But the corporate owner of real estate sells its asset to an investor. It can be a real estate investment trust, it can be a private investor, and leases back the property for a long period of time, typically anywhere between 10 and 20 years. This has several benefits for the corporate user. One, it monetizes a relatively liquid asset, so you can pull cash out of the building. Two, you can get 100% of the value of the building in return, as opposed to a loan from a traditional lender where you may get anywhere from 60 to 70 or 80% at best for most companies of the loan. So it provides more liquidity quicker. Corporate user still gets to maintain operational control of the facility. So its core functions of its business operations, where it makes its money, where the corporation makes its money, are left in the hands of the corporate now tenant in the transaction after a sale-leaseback to an investor. The last, one of the other remaining benefits is that it reduces the debt of the company, improves the balance sheet, has other tax benefits that, if properly structured, Mario will speak to, benefit the company a great deal, and provides liquidity for the company to reinvest in its either operational efficiencies of the building or other buildings they own, or the operational efficiencies of the company, or the sales force of the company, or equipment investments that make the company more profitable.
And also, Jeff, from a tax standpoint, you've got the opportunity to, in the case of a seller who becomes a lessee, they have the ability to ultimately take what would otherwise be a mortgage payment that would go to both principal and interest and have it instead treated as a rental payment, which is fully deductible. And also, as you mentioned earlier, there's an opportunity to relieve a liability from the balance sheet in the case of a sale-leaseback transaction. But there are some things from a financial accounting standpoint that have to be reviewed as part of that transaction. in particular as to whether or not the lease would be treated as an operating or capital lease.
Explain that in a little more, just briefly in a little more detail, if you will.
Well, in general, if it's a capital lease, you may not end up if the lease term itself goes out for essentially more than 75% of the useful life of the asset. It may, in fact, end up being recast as a capital lease, which essentially would have to be booked anyway. So you're not necessarily, you may be relieving yourself of a mortgage, but you'll end up putting back a liability on the books. Whereas if it's treated, in fact, as an operating lease, you may also get the benefit of having that removed from the books completely. So there is some review that needs to take place as part of the transaction.
Right.
On that aspect, anyway.
And I think that says very clearly that if a sale-leaseback is an opportunity that a corporation pursues, it needs to be structured properly upfront from the very beginning, not just finding an investor to buy the building, but how is it structured to benefit the corporate seller and owner today, how to benefit them, how to maximize their benefit, actually.
Correct.
I think what we would all three agree is that as CFOs and CEOs and depending on the size of the company, other C-suite executives look at their assets as they do with everything in their business, whether they're a $5 million a year company or a $1 billion a year company. You should always consider the sale-leaseback of some or all of your real estate. Many companies shouldn't do sale-leasebacks at the end of the evaluation. Many shouldn't do them on certain properties, but many should do them if they look at just a numbers and control perspective to untap that value, especially in this market where, as Chad alluded to earlier, you've got to grow businesses now. We're kind of out of the survive mentality and we're into the growth mentality. And banks are not as easy to deal with as they used to be, if they ever were.
Now, Jeff, let me ask you, right now, as I mentioned earlier, many companies are having a challenge raising capital, finding capital to be more restrictive. And in line with that, I know there's some challenges in terms of doing corporate sale-leasebacks. In other words, some companies are struggling a little bit, and that may be one of the challenges. But talk about a little bit more about some of the challenges that companies face in trying to do a corporate sale-leaseback.
I'll be honest with you, I think the first challenge is emotional. It's giving up ownership of an asset that, especially if you're an entrepreneur, you've probably invested more than just money into your property. You've invested image and brand and your own sweat and design and such, and it's been a form and function of the company. The important thing to note in that challenge is it stays as part of the company. Nobody on the outside knows that it's anything but what it was. If it's your corporate headquarters, if it's your primary manufacturing or distribution facility, it all looks the same. This is purely an asset and financing and return on asset program. If it doesn't produce a better return on asset for most companies, then you probably shouldn't do it.
And there's also an opportunity in some cases to structure it such that the company can in fact repurchase the asset down the road. So if there is some emotional attachment, perhaps that might mitigate to some extent.
Good point. Good point.
Mario and I had an interesting discussion as we were preparing for this, and it's the business decisions that we all make because we all run companies as well as advise companies.
Right.
You have to look, real estate is, while it's always been a solid investment, it doesn't appear that it's going to appreciate dramatically over the next few years. If you have a core business that is with growth dollars and with honing your business and doing everything you've done over the last 4 years as an owner of a company to enhance the company and get it moving forward again and surviving this downturn, but now starting to prosper, if you can make 10 to 15 to 20% return on capital invested, the real estate's just not going to do that over the next 5, 7, 10 years perhaps. It'll make 1 or 2 or 3% increases. So it's often a great